Okay, all right. So let's start. So basically, um, when we talk about trading, we are basically talking about the buying and selling of an asset or of a good or something. Okay, and when we say buying and selling, we are talking about two players here. There is a buyer and there is a seller. Okay, so there's someone who is buying the good and there's someone who is selling the good. Okay, so in Forex example, we also have the buyers and the sellers, right? And so because of that, we can classify the market into two categories. One is a bullish market, and then the other is a bearish market. So, in trading, we usually call the bulls or like those who buy or the buyers. We term them as the bulls. Okay, like the bull, and then the sellers we call them the bears. That's like animal bear and then animal bull. Okay, and when we want to classify what type of markets is all like basically the direction or the trend of the market, we can either say the market is bullish or the market is bearish. So when we say the market is bullish, it basically means that the price is going up. Now, most people ask this question, okay, if it's bullish and it's going up, I mean, what does it mean? Why is it going up? Why is it going up and why are you calling it bullish? So in economics, there is a we have the law of supply and demand, okay, and the law of supply and demand. I've forgotten what the law states, but basically, when like so basically the law of supply and okay, so David also anyway. So I was talking about the two types of markets, the bullish market and the bearish market, and I was saying that the bullish markets entail the buyers, okay, and then the bearish markets consist of the sellers. And I was saying like in trading, we have two concepts, the buying and the selling. Someone is always buying a good and someone is selling that good. Okay, so that's the same thing in the market here. And so for what was I saying? Yeah, so we have the bullish market, or when price is going up, we call it a bullish market. And when the price is going down, we call it a bearish market. So I was saying the reason why we call that a bullish market, or the reason why when the price is going up, we call it bullish, or we associate it with the buyers, is because of the concept in economics that states that when there's high demand for a particular good or a particular item or asset, the price goes up. Okay, that's like basic economics. When there's high demand, price goes up. So in other words, when people are buying or when we or usually hear that buyers have stepped into the market, it basically means that what's going to happen is the price is going to shoot or the price is going to go up. Okay. However, when the price is going down, it means that people are selling, right? That's what it means. I can give you an example. Okay, so let me give you an example of how these two work. So imagine, so the three of us here, I sell headphones. David, probably you sell books. And then Edgar, you sell, let's say, curtains, right? No, let's say we all sell the same thing. So I sell headphones, maybe from Beats. And then David, you sell from Oraimo. And then Edgar, maybe the Apple headphones, right? Cool. Now, I am selling my Beats at $1,000. David is selling his at 1,002. Edgar is also selling his at 1,000. Okay, come. Let's say all these different types of headsets have the same qualities, right? What would induce people to come and buy from you? What would attract people to come and buy my good and not buy yours? If for instance we're all even selling the headphones from like if for instance we're all selling headphones from Beats by Dre, right? What will entice people to come and buy is basically the price. Okay, so if I'm selling mine at 1,000 and Edgar too is selling his at 1,000, obviously it means would not nobody will really be making profits. But if you realize that so many people start buying the Beats by Dre, maybe for some reason there's high demand, or for some reason maybe they did a very sweet commercial that has gained public attention for some reason, then what happens is now people will start buying. Now, when people start buying these headsets, what do you do if you want to make profits? You start increasing the prices. Okay, so in fact, let's just say I'm the only one selling the headphones. Let's just say I'm the only one selling the headphones, and I realize I'm the only supplier. So I realize everybody's coming to buy. Obviously, if there's high demand, I will start increasing the prices, and people will still be buying. Why? Because there's high demand. Just like during the COVID time, when COVID hit fresh, and then we had with like a high demand for the nose mask and the hand sanitizers, and the price shot up massively. But what happened? People were still buying because yes, demand is high. So that's what happens when the demand is high, the prices go up because the people who are, I mean, because people need to make profits. So the price will keep going up, keep going up, keep going up. However, this is where this example comes in, like the one I gave about the headsets. So, however, if you I mean, like we all sell our headphones at 1,000, and obviously nothing would call people to come and buy from me or to buy from you unless maybe your advertising was better than mine. However, one of the key factors is price. So if I drop my price from 1,000 to 900, people will come and buy from me. Okay, which means I would steal, or I would attract all the buyers to me. And then Edgar and David, you guys will probably not have anyone buying because yours is more expensive. So that's how the sales work. When people are selling, the price drops. So in other words, everybody wants to make profit. So I'll drop my price to 900. David will drop his to maybe 850. Edgar will drop his to maybe 600. And that's what happens. So they'll keep dropping the prices down to a point where they can't drop it anymore. And then, so that's the cycle. That's the cycle of price. It goes up, comes down, goes up, comes down, based on supply and demand. Okay, so those are the two factors, like the two key factors in trading, how the buys work and how the sells work. Okay, so the next thing we're going to look at is the various instruments that we trade. So that's what we have here. So this chart is TradingView. This site is TradingView. Okay, and TradingView, we use it for analysis. Some people can take trades on them, but since we are doing Forex here, Forex is basically foreign exchange. Okay, and when we say Forex, we're talking about currency pairs. So that's what we have here. And then there are people who also trade stocks. So there are stock traders. There are also people who buy the shares. So you can see stocks. You have Tesla, Nvidia, Apple, Amazon, Meta, blah blah blah. We have futures. Futures has to do with you can see SM. Okay, so let me go to indices. Okay, so we have indices. Indices have to do with, like, I don't know if you've heard of US 30, but when someone says US 30, they are basically talking about like the top the top 30 tech companies in the US. Okay, or maybe if it's S&P 500, maybe the top 500 companies, and then they bring their, I don't know if it's called GDP or whatever, but they bring their GDP together. All these things, like, it determines the country's economic growth. Okay, so these things are also markets. They are instruments that people can trade. Okay, so that's indices. Then we have cryptos, so BTC, Ethereum to USDT. Yeah, so in Forex is basically currency pairs. Okay, and the way we read these currency pairs is, you can see we have EUR USD. So that is the abbreviation for a currency pair. So EUR is euro, as you can see there, and then the USD is US dollars. So with this pair, for example, on the left hand side, every currency that is placed on the left hand side of the currency pair, we call them the base currency. So here the euro is the base currency, and we know that a base is 1. Okay, so base is always 1, and then the currency on the right hand side is the quote currency. So that is the US dollars. So if you look at this, for example, here, GBP JPY, that is the Great British Pound against the Japanese yen. Okay, so the Great British Pound is the base currency, and then the Japanese yen is the quote currency. Now, why is this important? So the base currency is 1, okay, and then the quote currency is the price that we see on the chart here. This is on the y-axis of the chart. Okay, so on this chart we have two axes, basically the y, which is the price of the quote currency, and then the time, so plotted against time. Okay, so the price of the quote currency in this case is Japanese yen. So in other words, we are saying one British pound will give us how much Japanese yen? And currently, this is the price 191.348. So it's basically saying one British pound right now will give us 191.370. Okay, so that's how, that's why it's important to know or to identify which one is a base currency and which one is a quote currency. Okay, now, in ancient times, um, the way people were trading then and now is completely different. So previously they used to use just lines. Okay, this is how they were trading. So we just look at the lines and then predict whether the price is going to go up or it's going to go down. But I think in the 19 something, one Japanese guy, that's what we are going to look into, the candlesticks. So one Japanese guy or invented the candlesticks. Okay, so the candlesticks are these things here, these individual boxes, and they help you to know the real story behind what price is doing. So in other words, it's telling you what is happening currently in the market, or how strong are the buyers in the market, or how strong are the sellers. In a market, when there are more buyers than sellers, the price will go up. It's like maybe war. Let's take a war, for example. If is a fight against the buyers and the sellers, if the buyers are more than the sellers, then the buyers would obviously control the markets. And when the buyers are controlling the markets, it means that the price would be going up. But if the sellers are more than the buyers, then it means the price would be dropping, or the price would be dipping or sinking or falling. Okay. And these candlesticks here, they are formed per a particular time frame you decide. So I usually tell people that like the time frames are like the scope. It's like your lens, like how you want to view the market. So we have different frames here. We have the 1 minute, the 5 minutes. So currently we're on the 5 minutes. It basically means that every candlestick here is formed 5 minutes. So if you check, I've currently highlighted this current candlestick and it was formed at 3:20. Let's see the time. So at 3:25, this candle will close. And you can see here, it's counting down. So at the end of this candle's life, the next candle will form. Okay. And then that's how it goes. So this is the 5 minutes. So every candle on the 5 minutes time frame charts. Every candle on the 5 minutes time frame chart is formed every 5 minutes or has a lifespan of 5 minutes. If you go to the 1 hour, is different. So on the 1 hour, this candle here was formed at 3 and it would close in 35 minutes. This candle was formed at 2, formed at 1, formed at 12, and that's how it is. So now let's go and look into the anatomy of a candlestick, because now you can see these are candlesticks. You see two different colors, you see some lines passing through. How we read them, how do we read them in the market? So that's where the candlestick Bible comes in. And basically reading the candlesticks, we call or traders that read candlesticks to determine where price is going or to analyze, we call them price action traders. Okay, so honestly, candlesticks tell you everything about the markets. That is the truth. Candlesticks tell you everything about the markets. A trade I took today, for example, I needed some more confirmations, but it was just because I could clearly tell what the candlesticks were doing. Because I could read the candlesticks, I could tell, oh, it's going to sell. And then just from here, ideally, I would have waited for some confirmations, but I sold early because I could read the candlesticks, and then I could tell the sellers were stronger, or at this point, the sellers had jumped into the market and buyers were not able to push the price up. So it would be a good time to take a sell. And then that's what I did. Took a sell in the channel and then made profits here. So I sent it at 2, 3. Yeah. Okay, so let's go into the candlestick. So basically it's good to read candlesticks and to understand them, but you can't use them alone. You need certain tools and certain factors. But let's start with the candlesticks for now, and then would go deeper into the analysis. Like I was saying, candlesticks have been around a lot longer than blah 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 blah. So I'll send these books to you guys. I'm sure maybe some of you already have them. Okay. So why candlesticks are important to your trading analysis? Candlesticks are important to you. Okay, so they are important to your trading analysis because it's considered as a visual representation of what's going on in the market. So, like I was saying, it tells you a story, it tells you what's happening. And by looking at the candlestick, you can get valuable information about the open, high, low, and close of price, which will give us an idea about the price movement. So when they say the open, it's basically saying, like I mentioned, the candlestick has a lifespan. So obviously, when one candle ends, the next candle would open. So that's the open price. So the open is where the candle starts its life from. The close is where the candle ends. The high is the highest price level the candle got to, and then the low is the lowest level the price. Sorry, that candle got to. So if, for instance, we have let's look at, let's say, 4 digits, right? So we have one, let's say 1, 2, 3, 4. Okay, so 1, 2, 3, 4. Now let's say this candle opens at 2, let's say $2. So the candle opens at $2, and then sellers push the price down. So the candle goes all the way down from maybe $2 to $1.80, $1.20, and then the lowest level it got to was $1. Then at $1, so many people were buying. Buyers came into the market, and so the price shot from $1 all the way to, let's say, $4. Okay, so we have our open. So price opened at $2, went as low as $1, went all the way up to $4, and then for some reason the price dropped a bit and closed at $3. So those are the vital informations. Something like this will tell you that, okay, if the price opened at $2 and closed at $3, then it means the price has gone up, which also tells you that what the buyers are in the market, or currently it looks like there's some sort of bullish pressure or bullish momentum. So, like I was saying, when I say bullish, talking about the buyers here. So there's some sort of bullish momentum. Okay, so that's the kind of information it gives us. It also tells you, I mean, you can read more, but I don't want to go deeper into this. So this is it. Okay, so this is what we saw on the charts, but these are just different colors. So you can see the line in between. We call it a shadow. Some people call it wicks. I call it wicks. Okay, and then this is the body. So this rectangular box is the body of the candle, and the body of the candle. Okay, so I'll go into that later, but this is the body. Okay, this is the high. This is the close. This is the open, and this is the low. So like I was saying, maybe that candle opened at $2 here, went as low as $1. Because when you plot it on the chart, I mean on the axis, it will be 1, 2, 3, 4. Okay, so 1, 2, 3, 4. Okay, all right. So price would open. Sorry, this candle, let's say, is forming every 15 minutes. What's the time now? So the time is 3:29. So let's say at 3:30, this candle here would open, and then it opens here at 3:30, and then it's for 15 minutes. So it will be going down, going up, going down, going up, all in 15 minutes. It will go as low as this, go as high as this, and then at the end of the 15 minutes, it closes here. Then the next candle will form. The next candle, this one here, would also open here, go all the way up, go all the way down. The same 15 minutes. So this will close at 3:45, and this will open at 3:45. Close here, and then so that's it. So basically, we have two types of candlesticks, like you can see here, two different colors. So the whites in this trading Bible is for the bullish. It's called a bullish candlestick, or for the buyers. Okay, and then the black is for the bears or the sellers. So what it means is, so if the close is above the open, we can say that the candlestick is bullish, which means the market is rising in this period of time. And like I already explained, when price goes from 2 to 3, it means it has risen. It means it has gone up. Why? Because, like I was saying, when there's high demand, price goes up. So it's good. I mean, it shows there's bullish pressure. Okay, and then the direct opposite is for the seller. So when the price opens here and closes below it, let's say it opens at $3 and closes at $1, then means the price has dropped. Okay, so that's a bearish candle. So in this book, so you can customize the candlesticks whichever way you want, right? So I made mine blue and red. So, but this pool, this is white and black. Okay. But yeah, so they are saying the color doesn't matter. You can choose whichever color you want. And then if the close, so this is for a bearish candle. If the close is below the open, we can say that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candlesticks are always displayed as black, but this is not a rule. Okay, so now let's look at the body of the candlesticks. Now, the body of the candlesticks also give you information, valuable information about what really is happening. So the longer the body, the higher the pressure. Okay, so it's like if price opens at 2 and closes all the way at 10, it means that, so imagine here, it opens at 2 here and closes all the way at 10. We'll have a very long body, which means there's strong buying pressure, or like the strong bullish momentum. Okay, but if it's small, it means like from 2 to 3, it means there's not much bullish pressure. Or if it's for this, or if it's a bearish candlestick, then we see there's not much bearish pressure. Do you understand? So long bodies refer to strong buying or selling pressure if there is a candlestick in which the close is above the open. Close above the open, that's a bullish candle with a long body. This indicates that the buyers are stronger and they are taking control of the market during this time. So basically, people are buying and the price is going up. Okay, and then on the other hand, it's the same for the sellers. Short and small bodies indicate a little buying or selling pressure. So there's not, or selling activity. There's not much really going on. Okay. Yeah, so this is another type. So when we have a candle like this, it usually indicates reversal. So when you look at the formation of the candle, that's the last thing we look at, I think, before the meeting ends. But when you look at the formation of the candle, sometimes you see that this line here shows the path that price has taken in that particular time frame. So this is the lowest level, this is the highest level it has gone to, right? And then all here, this will just tell you, because it's black, so it means this is the open, the line on top is the open, and then the bottom line will be the close. So this will just tell you that maybe for some reason the price opened here, sellers pushed it all the way down, then buyers pushed it all the way up, and then maybe at this level sellers came in stronger and pushed the price all the way down. So at the end, getting to the end of that particular time frame was when the price dropped all the way and closed below the open price. Like what happened yesterday when who even scored first? Inter scored first, and then after second half, Barca gained momentum, and then they fired in. Okay, they scored 2 goals, scored 3. Now that's how it is. So, and it was getting to the end of the game. Now, if the match had ended at, let's say, at 90 minutes, it didn't go to extra time. If the match had ended, it would be a candlestick that will form in favor of Barca. Okay, it will be a candlestick that will form in favor of Barca, because getting to the end of the time frame or getting to the end of the match, it was Barca that gained momentum. However, what happened was, getting to the end of the match, Inter came in. They came in stronger, equalized, which means that Inter also had momentum just at the dying minutes, and then that momentum carried them into extra time. That's the same thing with trading here. Usually, when, let's say, buyers come in, getting to the end of the time frame, like getting to the end of the lifespan or the life cycle of that particular candle, that momentum usually enters into the next candle. Okay, so these type of candles here can show reversals, or they give you information basically. So like what happened yesterday, because Inter scored at the dying minutes, when extra time started, they scored again in less than 10 minutes. Okay, because they had the momentum getting to the end of the game. That's how it is. That's the same thing that happens, not every time though, but like that's what also happens here. And that's why this gives us a lot of information. So candlestick patterns. So yes, candlesticks, they don't live alone. I mean, when one candle forms, the next one opens. So when one forms, like I was saying, the next opens, and then it gives you more information. Okay, so now let's go into the charts and look at some of the candlesticks and their formation. So this is the Australian dollar against the US dollar. So one Australian dollar will give us 0.64586 US dollars. Okay. So I'm going to the 1 minute so that it forms, so you can see how it's forming much more quickly. So like for me, my bullish candlesticks are blue and then the bearish candlesticks are red. Okay. So the bullish candlesticks indicates that the price is above the open. Okay. But when the price is so you can see here initially was blue and now it went below the open price, so it turned red, but now it's gone above the open price and so it's blue again. When it ends here, you'd see, you see the close after the candles, after this countdown, the countdown ends. Okay, so the candle has closed. The next one should open. I don't know if there's a lag. So this is real-time data actually, so maybe there's a lag or something. But okay, so the next one opened. Okay, so you can see it didn't start from the 59, so it means maybe my network or something. But it means that this candle here opened here, went all the way down. This is not even all the way. So sellers pushed the price a bit down, and then buyers came in strong, pushed it all the way up, getting to the end. So like I was saying, the example I gave, getting to the end of the 1 minute was when we saw that the candle went above the open and massively came here. And now what has happened? The next candle here is bullish, like I was saying. So usually when it ends with momentum, the next candle also continues with that momentum, and you can see the momentum going. Exactly. So that's how it is. And this is the 1 minute. So every 1 minute, these candlesticks are forming. Okay. Let me look at different charts, see if you can see a bearish candle forming. Okay, so same thing here. This one turned bullish. The next one is bullish. Maybe see, maybe gold. Okay. So for gold, same thing. This candle is bearish here. So you can see it's going down massively. Okay. So as you are watching this, are there any questions or any contributions or anything that you need clarification based on what we've done so far? We've looked at the concepts behind trading, the buying and selling, how to, and what makes price go up or what makes price drop. We've also looked at the candlesticks, how to read them, basically. The two types of candlesticks. One is the bullish, which is associated with the buyers, and then one is the bearish, which is associated with the sellers. Okay, and then we've looked at how the body of the candlestick also gives you crucial information. The last Zoom meeting I did, I was teaching, like we're going over these candlesticks here, so the bearish engulfing and the bullish engulfing, but I feel like maybe the next Zoom I can just briefly brush through them. But let me give an example. So let me just brush them briefly before the time ends. If there are no questions, then I'll just brush through it briefly. Okay, all right. No question, right?
No question. I don't
Okay.
have one.
Okay, bet. So we have 4 minutes left. Okay, so let's look at the engulfing bar candlestick. So the engulfing bar, as it states in its title, is formed when it fully engulfs the previous candle. So the engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, at least one candle must be. So it's basically saying this is the previous candle and this is a bearish candle. In this book, this is a bearish candle. So this bearish candle here has engulfed this one. This is a bullish candle. So here it's showing that there was little buying pressure. So yes, there was little buying pressure. And then what happened? Sellers came in strong and then formed a very long body of a bearish candle, which indicates that now sellers are in the market. So this is what it's saying. The first body is smaller than the second one, and the second body engulfs the previous one. So this is how a bearish engulfing bar pattern looks like on the chart. So on the chart, you see this type of pattern. So this is just an example. So in case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, so this is an uptrend. An uptrend is a trend where buyers are in control. You see, if it's going up, it means buyers are in control. But when it got to this level, what happened? There was little buying pressure. Buyers could not push the price up anymore, which also means that if buyers cannot push it, then it means sellers are strong at this place because it's a relationship between the two of them. Do you understand? So if one is losing pressure, one will be gaining pressure. So that's what happened here. Buying pressure was lost, and then selling pressure stepped in. After the selling pressure stepped in, this a bearish engulfing. This is an indication to take a sell. Okay, so you take a sell because you've seen that sellers have stepped into the market, and then what they're seeing here have engulfed. So sellers have engulfed the buyers, which in the signals a reversal, a trend reversal. So from an uptrend to a downtrend, and then this is what we had here. So as you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are still in control of the market and sellers are trying to push the price down. Okay, but they're saying you can't trade it alone. You can't trade any bearish candlestick pattern. You find in your chart, you need other tools, other strategies. Okay, and then there's a bullish engulfing. Same concept. This selling pressure, very little low selling pressure. Then the buyers stepped in with massive momentum, which indicates what the buyers have overpowered the sellers, and the market is most likely to go up. So when you look at it here, we can see something like this form. So this previous candle is small, and then this bullish candle here is much larger than the bearish candle or this previous candle, which is an indication of a trend reversal. So like I saying, sometimes the color of the body doesn't matter, right? But what's important is the smaller one is totally engulfed by the second candle. So don't try to trade the market using this price action, blah blah. And then the last thing I looked at with them was the doji. So the doji is where you see this is you can't see the open and the close. So the open and close are on the same line, which usually means that there's indecision in the market, or I mean, buys is like a draw. So if it's a draw, it means there's a chance either of them is likely to take over. So if the market is already going up and you see something like this, it also means that sellers have come in strong and now they are putting pressure on the buyers, or like they're also flexing their muscles. They are making it a tough time for the buyers to keep pushing the price up. And then for some reason it closes around the open. Yeah. So that you don't see it perfectly as a cross or like a plus like this. Sometimes you see a very little but usually these things indicate reversal. So you see this and then reversal. I think that is basically it. The meeting would end very, very soon. So I'm trying to see if I can find so you can see a doji here. So a doji, something like this. So came down, went up a bit, and then a doji. After the doji, we had a massive sell. So reversal. So this is an uptrend, like a mini uptrend, and then we had a doji.